Time to take some risk off the table. My next guest says, okay, sure, but if you're looking for safety, you might actually find it in the growth stocks. For more, I'm joined by Rebecca Patterson. She's Director of Investment Research at Bridgewater Associates. Rebecca, it's great to see you. So we can start there or, kind of your gut check on 30,000 following the chat that we just had. What are you thinking?
Well, with 30,000, I feel like I should have worn green rather than red. But I think we set this up so technology is a safety stock. I think we probably need to explain what the heck we're talking about. And I think the big picture thing here, what's really important is to understand what this policy mix that Dominic Chu just talked about, incredible fiscal policy, really coordinated with monetary policy, what that means. Because this is something new. And as we see this rotation trade continue, it affects how that rotation trade will work versus the past. So it's important for investors to understand. We grew up with the Fed cutting interest rates. That worked great till 2008. And then when that no longer was effective, they moved to asset purchases. That worked until the pandemic. And when the pandemic came, monetary policy alone wasn't sufficient to really lift us out of that. And so we had to have this more coordinated fiscal monetary mix where the Fed is buying assets, keeping yields down, facilitating the bigger budget deficits. Now, how that plays into tech, I think the main point is that with yields low and likely to stay low for a long time as the Fed plays this role, people have to move out the risk curve. They're owning more stocks. They need to get their return. But you don't want all the stocks you own to have that high cyclical correlation. You want some stocks to have more bond-like attributes. And that's what helped a lot of the technology, a lot of the growth names earlier this year. High free cash flow, strong balance sheets. They're going to survive no matter what the economy throws at them, as well as some structural supports. But I think when we're talking about tech here, it's interesting to me today that the NASDAQ is up over 1%. It's underperforming, but the exodus out of it is not necessarily the same in the rotation that what we've seen in the past. And I think that ties back squarely to this new monetary policy mix.
No, and what you're saying echoes what Ed Yardeni said last hour. He calls it T-Fed, and that's reinforced by Yellen being Treasury Secretary in a Biden administration. Just how closely these two organizations are working together. But let me ask you something about this. And again, to make sure people kind of grab onto what you're saying a lot of these mega cap tech names, and again, there's a reason we now find some of them in consumer staples, but these are kind of the new bonds. This is the new safety trade. And my question on this is, what about everybody who says, well, wait a minute, I'm looking at bond valuations and I don't like them, but I look at the valuations of some of those names and I don't like them either. I mean, how much of a risk is that?
Right. No, I take your point. And certainly there are some signs of froth in some corners of the market. So I don't want to dismiss that at all. But if people are taking a longer term view, what am I going to put in my portfolio for the next few years if bond yields are going to stay low? I mean, the Fed's saying they're not raising rates at least until 2023, and that's going to keep a lid on the whole curve to a degree. So what do I own? And I think looking within the equity market, whether it's stable cash flows, types of companies where the revenues are going to be fairly stable no matter what the economic environment, companies that have certain attributes, again, those things are going to be in favor when growth slows down or disappoints. So I am cognizant of the valuations, absolutely. But you also have to think about what basket of stocks do I want to have if part of what that's doing is replacing my bond portfolio. Now, stocks certainly aren't the only thing to look at. There's going to be lots of other diversifying assets to include in that mix, whether it's gold, whether it's inflation-linked bonds, whether it's different types for some Bitcoin. Investors of private markets. So when I talk about tech stocks, I'm not saying that's the only thing you should look at, certainly not. But it does play a role within the equity market that I think could be different from past rotations.
Yeah, it certainly describes the nature in which they've behaved this year. They have been a flight to safety trade, no question, and certainly give you better growth exposure than bonds. Rebecca, thanks so much for joining us today. Good to see you.
Great to see you.
Rebecca Patterson.
Shepard Smith here. Thanks for watching CNBC on YouTube.